Hello, everyone. Welcome, welcome, welcome. We are so glad to see some new faces and some return faces. Here's Fred. We got to meet him in person, and Larry Blake is here, and a few others who got to come to our Houston party. And other people that we get to meet in person is really great. We're very excited about that. And today we have a special guest introducing our special guest speaker. So, Douglas, take it away.
Thank you so much, Peggy. Thank you guys for having me today. I've been honored to introduce our guest speaker today. Our guest speaker, Cliff Morgan, as we all know and love, has been a member of the group for as long as I've been a member, and probably much, much longer. But for those of you who don't know, Cliff has worked with many Fortune 1000 companies for 20 years, understanding their business needs and company goals, in order to find ways to increase efficiencies, reduce their costs, and create additional streams of revenue. Now, for those of you who don't know, Cliff currently raises capital for high-end commercial and industrial properties, and also provides financial services. He will utilize these skills today and show you how and where you're paying more than you have to on your mortgages, the rule of 78, and why it's more important than ever to build equity in your real estate portfolio today. So please join me in welcoming Cliff to the stage.
Thank you very much. So let me go ahead and share my screen here, and I'll go straight into starting. Okay, can everyone see my screen okay?
Yes.
All right, so today I'm going to show you how the banks are using interest to get paid, and how you're going to flip the script and accelerate your net worth by understanding interest. So historically, interest rates have been all over the place. Now, according to Value Penguin, by December of 2020, the 30-year mortgage rate plummeted to a new historical low of 2.68%. Rates spent most of 2021 between 2.7 and 3.1%. And in 1981, continued hikes in the Fed funds rate pushed mortgage rates to an all-time high of 18.45%. Kind of makes you wonder, could we go there again? Now, according to Forbes, our current rate is somewhere around 6.68%. Now, we used to see in our closing documents the federal truth in lending during our closing. Now, I don't know how you reacted when you saw this for the first time, but you may have gasped and panicked like I did. Now, I truly believe that that's why they moved away from truth in lending. And on October 3rd of 2015, this was replaced and added to the fifth or last page of the closing disclosure. And instead of a large legal size sheet of paper, it was reduced to a corner in the upper left-hand side of the last page of a letter-sized document. Most people don't even see. Now, they made this really small in comparison to what it was before. Kind of makes you wonder why. Now, if you notice, there's something new called TIP, and it's right here on the bottom right-hand side, okay? And you'll notice that with this rate of 3.457%, I'm paying more than 56% in TIP. Now, that's total interest percentage. Now, I truly believe in tipping. I really do, for great service. But I don't think I've ever tipped more than 56% on anything. Now, why do lenders demand this? And why is it so much more than the interest rate? Well, let me ask you a question. How often does the average mortgage get sold or refinanced? The short answer is every 5 to 7 years. Now, why is that, you wonder? Well, let me show you.
Yeah.
Okay. So I've created a couple of spreadsheets that I'm going to go over, and this is for 2021. And I've used an average loan amount from 2021 of $313,051. And the lowest interest rate, which was from December of 2020, so your payment would probably start around February, of 2.68% for 30 years. And we're going to put in there the average property taxes that were paid in 2021 of $37.19, and the average homeowner's insurance amount that was paid for 2021, which was $23.05. And that gives us a PITI, principal, interest, taxes, and insurance, of $1,768.43. Now, if we focus over here on the right-hand side, we'll see the balance at year 7, okay? This brings us all the way out to January 1st of 2028. The interest that we paid into this so far at 2.68% is a whopping $54,029.57 on a principal amount that we paid in so far of only $52,350.55. Almost $2,000 less than the amount of interest that we paid. Now I look at this and I kind of scratch my head and I'm like, okay, wait a second, this is only 2.68%, right? Well, not really. Remember that tip I was telling you about earlier, the total interest percentage? Well, just on this, it's 45.64% is what you're actually paying. And if you break it down even further and we look at how these numbers look for each year, so I've got the year over here, we can see on the right-hand side, the amount of interest paid and then the amount applied towards principal. You can see the percentage that's applied towards principal and the percentage that's applied towards interest. And if you want to break it down a little bit more, how many of the payments did I make in my first year that actually went towards principal? And in this case, it was less than 6. Okay. If I go a little bit further out, let's go out to year 7 and see what this looks like. Okay. And in year 7, my total interest paid in, there's that 54,000, and total principal paid, there's the 52. Okay. And we can see now we've got just over 6 payments being applied towards principal. Yeehaw. You know, the rest is all going to be in interest. So not really encouraging. Let's fast forward to something a little bit more relevant today. Okay. And let's look at the average loan amount this year so far, which across the country is averaging about $413,200. And Forbes just said the most current interest rate is at 6.68%. Some people might be able to get it for a little bit less today, but we're just going to use where they say we are. So the first payment, if it started today, might be due somewhere around November 1st of 2022. We're going to keep the property taxes and insurance in the exact same place that we had it for 2021, and we're going to look at how this changes. So you can already see our PITI is considerably higher than what we had with the 2.68%, but we also have a higher loan amount too. So both of those kind of work in together. We look over here for the balance at year 7, we see how much we're paying in towards interest. So at year 7, we paid in $185,000 in interest. And in principal, we've only applied $38,409.97 to principal, a far smaller amount, leaving us still a pretty huge outstanding balance on that original loan amount. Mm-hmm. And when we look down below at that tip again, this will make your eyes bulge, you know. And again, I truly believe this is why they did away with the truth in lending document. It's 131.82% is what you're actually paying in there. So on the original loan amount, we're actually paying twice and almost a third again on top of that to get this loan. That's a lot of money. Now, if we break this down similar to what we did in the previous example, we'll see here again for year 1 how this breaks out. And we see the amount that we paid in towards interest at just over $27,000. But the amount applied towards principal is just over $4,000. Okay. The amount applied to principal, now you can tell there's a huge difference in this versus the 2.68%. This one, we only have 13.98% being applied towards principal and 86% being applied towards interest. Less than 2 payments in the year is actually going towards principal. Our total interest paid, $27,000, $4,000 for principal. And we go down to year 7 to see how this looks. And we have the same numbers that we have up above, but we also have our percentages. So 20% is applied to principal, where 80% is applied towards interest, even at year 7. And approximately 2.5 payments are being made towards our principal at this point. Okay. And then where would you think that the halfway point would be in the amount that you pay in for the year, balancing out to where the interest and the principal are about the same in the same year? Most people would say it'd be around year 15. But if we go to year 15, you can see we're still at a 64.48 versus 35.52, with a smaller amount going towards principal. Now, only 4.25 payments approximately are being made at year 15. Remember, we're at the halfway point of a 30-year mortgage. Now, it's not until we go down to about year 20 that we start to see this balance out pretty close, and we're still not quite paying more in principal than we are in interest. And we have just below 6 payments being made in that. But then we're also at year 20, we're 2/3 of the way through a 30-year mortgage. And remember what I said earlier, the average mortgage is sold or refinanced every 5 to 7 years. So do we ever really see this typically? I venture to say the answer to that is no. Okay. Let's come back over here and let's show you a couple of numbers. All right. So when does 4 equal 24 and 8 equal 40,320? Well, if you have just 4 accounts that charge interest, there are 24 different ways that you can potentially build equity. But if you had 8 accounts that charge interest, like loans, credit cards, and mortgages, to build your portfolio, there are over 40,000 ways that you can build your equity. Now, at this point, I think you might be able to start to see how there could be some opportunities here. Okay, so let's jump right in and start off by talking about some technology. More specifically, though, let's talk about technology that we all tend to use today, GPS. It's a technology that changed the world. We just tell it where we want to go. And in an instant, not only does it give you the fastest route to your destination, it can also help you avoid certain places that might slow you down. Of course, all kinds of new technology comes to the market every day. But some advancements are the kinds we can't imagine living without, like cable television, the internet, smartphones, and countless more. These technologies have made such an impact that we use them in our day-to-day lives. And they're so important that we'll get someone to fix it the same day if they aren't working right. Well, imagine for a moment if we could leverage a sort of GPS technology that would do the same thing that our finances, and let's call it a financial GPS. It would help us get to our desired financial destination on the fastest possible route. And even more, it can also help us avoid any of the areas that may slow us down. Now, the destination is different for everyone. Some may want to go to the financial destination of owning their real estate outright, and they would like to get there as fast as possible. Then again, some want to go the financial destination that builds equity quickly so they can leverage that out when the time is right and expand their portfolio. Both are great financial destinations, and we've been helping clients successfully arrive at their desired financial destination with our financial GPS for more than 18 years now. Now, our financial GPS analyzes every aspect of your financial situation: income and expenses, amount financed in terms of each amount charging interest, reserve amounts, fixed versus variable rates, different loan types, and unexpected expenses. Now, what would your business be like, or how would it be different if you had a financial forecasting tool that could let you know whether or not you could afford a new property and how long you could carry it without rental income? What if you could buy a new truck financed for 60 months and potentially pay it off in 2 years or less? Many people think they know what this is, but first, let me tell you what it's not. It's not refinancing. It's not changing the standard of living. It's not a biweekly program. It's not a debt roll down program. It's not a reverse mortgage, and it's not a concept or theory. It's just math. And oh, by the way, it's also not a manual spreadsheet. This program enables you to control your cash flow and accelerate your net worth. Our program supports up to 100 properties. It always focuses on 3 things. 1, it makes sure everything is paid. And 2, it makes sure your reserves are met. And 3, it's constantly finding the fastest way to build your equity. And this program can also help you identify funds so no dollar goes underutilized. And it can also help you create equity even in a down market. You will know exactly how much to apply and when to apply the funds for maximum benefit. And the program automatically adjusts every time money moves in or out of your plan. If you have a line of credit, you can potentially take advantage of interest float as well. Now, if you want to take your camera out and take a picture of this page, it will make it easier to find these books a little bit later. I'll be putting a QR code up on the next screen, and you can see, you can use your camera to actually follow that link where you can schedule a complimentary consultation with me. And it's important to understand real estate has market cycles, and you want to understand what strategy to employ at each stage of the market cycles. These two books do a really good job of explaining what to look for in order to identify what phase you're currently in and the best strategies for that particular phase. For what is coming, building equity quickly can put you in a very strong position should real estate drop in value and the banks make it difficult to qualify for a loan, just like they did back in 2011. Now, during our complimentary consultation, you'll see how the program works and learn how quickly you can build equity. If you don't already have your camera phone out, pull it out and schedule with me now. If you have an Android phone, you may need to select modes and then the lens to capture the QR code link. And if you don't have your camera phone handy, you can manually type the link that I have right here in your browser and schedule with me later too. And if it's all right with everyone, I'm going to go to Q&A. All right.
Thank you. That was really terrific.
You're welcome.
Yeah. So, I always saw that when I was either doing buying a property, which, by the way, the first property we ever bought, we assumed a VA loan at 9% because the interest rates were at 18 point something. So we thought getting out at 9% was much better. And by the way, when that 18% came in, that's when the whole mortgage banking changed, and a secondary market was created. There was no secondary market before that. Before that, you just went to the bank and said, I need a little bit more money, and they would add it to your current payment, which is pretty cool. And you didn't have to qualify or do any of that because you've been working with that bank for all those years. Since then,
I wonder what house prices were like back then, Peggy.
Well, everybody was pretty much paying about 5% on their.
Well, I meant, what were the home values when they were around 18%? I wonder what the home value was back then. I imagine it was quite a bit different.
At 18%, we bought a house at it wasn't 18%. We paid $76,000 for a 2-bedroom, 1-bath, 1,200 square foot. Very nice, and rehabbed all of it. We did all the woodwork, all the framing, redid the bathrooms. We did almost everything. But the best part was we got the best oven we'd ever had in our life because you cooked without gas. I can't remember the name of it, but you put your turkey in and you'd run it at 450 for an hour and a half or 2 hours, and you'd turn it off, and 6 hours later, it was so delicious. That came with the house. And when we sold the house, we left that there because the sucker weighed like 3 tons. It was so heavy. Had a well in the back, all that. Anyway, so that was 9%, and pretty much several of the different homes we bought throughout time ran at about 9%. So when the rates dropped this time, my thought was, it's too good to be true. It's too good to be true, but I'm going to go in and going to refinance now, not knowing about all these things that you talked about with the refinance, not thinking about it. I saw it. I saw those truth in lending. I saw that you're going to pay 3 times the amount for the property, and decided that if you wanted to pay it off early, the thing to do was pay down principal so that you could not have to pay 3 times the amount, but that was always your choice. And most people, like you said, do a refinance so quickly. But the question I really have, because I wish I knew about this before my last refi, which was 2 years ago, and I am starting over, which the idea was that I was at a 5%. Now I'm at a 2 point something or a 3.1 or something like that, that it was worth doing we always said if it was worth 2 points. If it's 2 points lower, it's worth doing. You would not agree with that, I presume.
Well, it just really depends. So it's not just the loan that you're looking at. Sometimes it does make sense to refinance, and sometimes it doesn't. We actually do a complementary analysis to be able to determine, so we can run alternate scenarios to determine which way is going to be best for you individually. But I would say when you refinance, that's definitely the best time to look at really accelerating building your equity, because if you remember in the spreadsheets that I showed earlier, the majority of your interest is going to be paid in the front end of the loan. That's because how it's structured based on the rule of 78. So they load it very heavy with interest on the front end and more with principal on the back end, because most people never get to that principal part. Most people will either refinance or they'll sell their mortgage before they actually get to that point. So by doing that, the lenders always make sure that they're paid first.
Of course. What about for instance, what about paying extra towards your principal? So let's say you make your regular payment, but you also pay an extra $200 a month. Does that make a difference?
Oh, absolutely. Paying an extra $200 a month on the principal can certainly help you bring it down, but you're leaving a lot of money on the table, more than likely. So one of the things that really helps you aggressively pay down and build more equity into the principal is understanding where you are financially. And our program does an incredible job of understanding where you are to the penny and making sure every penny is utilized, and you get to establish the rules. So if you want a certain amount set aside for your lifestyle, so you continue living the way that you want to live, you build that into the program, and then everything else is aggressively applied towards the principal. So you're not actually spending too much or too little each month when you're paying extra.
So if you want to be free and clear of debt, what's his name talks about that all the time.
Beans and rice and beans guy.
Yeah, you said you made a comment about
no change in lifestyle.
But are you something about wasting money, or that's not what you said?
Oh, yeah, it actually makes sure that no money goes underutilized.
Right. So how are you underutilizing if you're paying principal each month? If your goal is to be debt free, how are you underutilizing?
So if you're paying $200 extra per month on your principal, what if you could actually be paying $300 or $350 a month, but you didn't know that you had that money set aside? Or what if in the other direction, you were paying $200 a month, not realizing that it was technically leaving you a little short, and you're floating part of your lifestyle on your credit card in order to make that? So there's a difference. So by understanding exactly to the penny where you are, you're much more aggressive in paying into your principal and building that equity much more quickly. And plus, it shows you to the exact day when, if you wanted to pay it off, it'd be totally paid off.
Got it. Okay, well, I'm in.
Save us, Cliff. Save us.
Yeah. Well, really, I don't think most people plan. I don't think they think about this. They just hear the rates drop down, so they automatically start a refi. I don't know, Marcy, do you have that kind of those kind of people come to you that have done maybe a business loan, and then they hear that the rate's gone down and they want to see if they can refi a loan they already have? Marcy, you're still muted.
I'm sorry, could you repeat the question?
Yes. Do you have people that have done a business loan with you? Now the rate has dropped and now they want to do a refinance on that loan. Does that happen in the business world?
Not yet.
Not yet. Okay. I was just curious.
So there was a question that came in the chat. And I'm not sure if this is really an appropriate response, but the question is it wise to refi multi-family units property that is to 1031 exchange in the next 2 months? That's not really something that I would know specifically. Peggy, you're very knowledgeable on 1031 exchange. Would you ever suggest doing a 1031 exchange if you're planning on would you ever refi if you're planning on doing a 1031 exchange in the next 2 months?
Well,
I mean, you're paying a lot of fees, right?
This is very complicated, because if you pull your cash out, then how are you going to do a good 1031? Because especially if you want to go passive, when you really need to have more principal in the next step than to have no principal. It could be very difficult because you might not have enough equity to be able to make the next step. And also IRS does not like you doing that because they think that there's some kind of fraud going on when you pull your cash out and then you sell the property. It's always about intent. Always about intent. Remember, it doesn't matter whether you pulled your cash or not. It's always on your basis what you owe, not on what you owe today, but on what you owe from your day you bought the property. What was your principal at that time, and what was your equity at that time? Not on the future, on the past. I don't know if I explained that correctly or not. My brain's a little exhausted, sorry to say.
Maria, did that answer your question okay?
Yes,
Excellent.
thank you.
Dave. Oh, Dave's making an offer.
I said I followed you, though. What you said made sense. Yeah.
Any questions on what we covered just now?
Yeah, somebody's got to have some questions. Who's done a refi in the last 5 years? Anybody?
I refied in 2018. I think
I had done a refi myself back in it was 2019. I had done a refi.
Yeah, I think I came down from 6.85 to, was it 4%? Where am I at now? 4%, 3%. 6.85 down to 3%.
Okay.
So then my question out of that would be, do you make this is just my own thinking. I would think that if you, I don't know what the new payment is, but if you were paying whatever it was at 6% and you could keep doing that, is there a reason that you wouldn't pay that extra down in principal?
So what I did is I did a cash out refi. Took 50K out and then went from a 30K to 30 year to a 15 year. So I think it cost me an extra $100 a month to refi from 30 to 15 years, and I got 50K in cash.
And you were able to go buy another property with that or something like that.
Yeah.
So we didn't talk about that, Cliff. What about that? Now going from a 30 year to a 15 year.
It's a big difference. So the amount that you pay in, interest is going to go down significantly. So once you get about 20 years or less in the term, the amount that you pay in interest is drastically reduced.
Over a 30 year.
Oh, absolutely.
No, but
at 25 and 30 year, you're going to pay a lot more in interest.
But he said a 15 year.
Yeah, 15 year, you're going to pay less in interest.
So are you still in that same kind of a divide where you're still paying a lot into interest and a little into principal?
It'll look a little bit different. Let me see if I can bring that up real quick and we can plug that number in.
What'd you say, Doug?
I'm going to assume you're still at that 2/3 mark. And so you probably won't start paying more towards principal until year 10, as opposed to year 20.
Maybe. Let's take a look. So if I change this from instead of 30 and make this 15, let's see how that actually looks in here. Now, this is the 2021 numbers with the lower rate at 2.68. And when we go down through 6732, 8 payments though are actually going towards your principal, so significantly more. So doing the shorter term definitely makes the difference. And then when we get to year 7, we're actually paying in 79% towards principal and 20% towards interest. So it definitely makes more sense with this to actually do a 15 year, but it depends on what you can afford in payment, because look how much more your payment is. So if I go back to 30, your payment is at $1,768. If I go back to 15, it's almost $1,000 more. It's about $900 more per month under this scenario. So if you can afford the payment, then definitely. But there could be a scenario where maybe you want to actually have a little bit more money to work with, and maybe you want to build equity in what you have. And who's to say maybe if the rate's decent, you do a 30 year, then you pay more into equity because there's so much in interest on the front end of this loan that you actually use that money just to build equity more quickly here. And if things go a little sideways for a month or two, you have a little bit of a cushion you can fall back on. That's also a different strategy you could consider.
So you're suggesting to keep the 30-year loan, but make it like a 15-year payment.
I'm not suggesting that. I'm just saying that's just a method that you could consider.
Right. No,
so it's all depending on what your personal goals are.
No. Oh, what I was suggesting was that if you had a 30-year loan, but you made it like it was a 15-year loan, you would have a different, you would see that more principal was being paid and less interest was being paid. Is that correct?
Yeah, correct. Yeah, you're going to pay more interest, and you're going to build more equity much more quickly, and you're going to reduce the amount of time that you're paying. And even on a 15-year note, many of my clients that I've worked with using our program, I've been able to bring them down, even on a brand new 15-year note. I don't typically save them a ton in interest. I might only save them $25,000 or $30,000 in interest, but I'm going to bring them down on average from 15 down to 4 to 5 years paying it off. So it can be a huge difference.
And
that's a pretty significant savings.
Is that a good tax strategy?
Well, that's the interesting point that you brought up, because a lot of people say, I never want to pay off a property because I can use it as a tax deduction. But I would challenge that, and I would say, if I gave you $1 and I got back 33 cents, is that a good deal for me? No, that's in essence what we're doing with the government. We're not getting dollar for dollar, on that. We're actually getting a deduction credit. So we actually get a portion of that back. So why would I want to let the government have that? If I really want to get a deduction, there are other methods that I could utilize. Find a charity, donate to a charity to bring your taxable income down. That's one method. Mm-hmm. But I don't necessarily have to have a mortgage in order to accomplish that.
So when you're actually working with your clients, you talk about all these different aspects of it, I'm presuming. Mm-hmm. And then do you bring in the CPA or have them check with the CPA about whether this is the right thing for them to do also? So they get that backup from the...
I find out on the front end if there's going to be any other parties that will be required in order to make a decision on this plan. And if at that time they let me know that they need to have their tax attorney or their CPA go over it, then I'll invite them to join us and actually go through it, because it's going to be really important to have them as an active part of it.
Yeah, I wonder if ever people think about having no debt whatsoever in this particular last 5 or so years, because money is... I
do.
Money is...
I'll be debt-free December.
Oh, congratulations. And money is so inexpensive, or was.
Yeah.
For the last several years. So people just think about, it doesn't matter whether you pay something off or not because money's so cheap. Do you see some sort of a change in that?
Oh, absolutely. And I've heard a lot of people, tell me this. I've actually had financial advisors tell me, why in the world would I have one of my clients pay off their mortgage at 3.25% when, it's such cheap money? And that's just simply because they don't understand how a mortgage is structured. They're financial advisors, but most financial advisors are very knowledgeable in bonds and in the stock market, but not necessarily in how a mortgage is structured and how much their clients are truly paying there. And if they do, then it's probably not a good story for them to share, because then they might not focus as much money in investing and they might actually pay off more. Just depends on individual circumstances.
Seema has a question or a comment.
No, I had a question. So you said you'll be debt free, but that's only personal debt. We like business debt because that's good debt.
And you're right. Sometimes business debt can be good because it can offset your income, and it can reduce your income, increase your expenses, and lower what you actually pay in taxes. But again, there are definitely other strategies that can work without having to go down that path.
Really, Cliff? I've just managed to brainwash my husband that there is good debt versus bad debt. Don't.
There is good debt versus bad debt. Yeah. That's a different topic, but you're right.
I'll argue about that to you on the phone. Okay.
Well,
Yeah.
yeah, businesses could use debt because they need to expand their business.
Yeah.
And yes, they get to deduct. Yes, go on, Doug.
I was gonna say, yeah, I do. I agree with Seaman in that regard. I just like to leverage other people's finances, especially when it comes to my business, as opposed to my own. Oftentimes, I can move faster if I'm using leverage, as opposed to if I'm trying to save every dollar and buy, cash free or debt free, I should say.
I definitely agree with you. And just like I said earlier, using the technology, some people actually want to be, on the financial path of actually having everything free and clear. And some people want to be on the financial path of just aggressively building equity in what they have so that they can leverage that back out and grow their portfolio very quickly and aggressively. There's been a couple of changes that have taken place here in the last few months. We've had a few rate hikes from the Fed this year, and I believe right now we're up about 3.25%, which is pretty high. And if I'm not mistaken, I believe the Fed has a potential intended direction of taking us to around 4.5% this year. So there are some people who have used credit cards to build their real estate portfolio. And in those cases, if they're not using a promotional 0%, that could really have an impact on their original financial projections. So this could be a tool that helps them build that back in very quickly so they're not hit with that added interest that they weren't planning for.
Thank you. Anybody else? Fred, you have any thoughts? Jean, you have any thoughts? Oh,
yeah, I have a quick question for Cliff. I did a refi on our personal home last summer. And the reason I did it, the rates were low, but I was already in an adjustable rate mortgage that was below 3%, but it was coming up for renewal or I guess the end of its 7-year term this year. And I didn't want to be stuck in that risky position. So I did it last summer and I got into a fixed rate at 3%. So I ended up paying an eighth more than my adjustable rate used to be, but it's locked in now for 30 years. And I looked at the 15-year or the 30-year, and from our cash flow standpoint, the 30-year looked better for ourselves and left more money for investing. But now I'm wondering whether I should have either gone for the 15 or I'm wondering if the option was there with lenders to do something in between, because I was already 6 years into the first mortgage and I essentially restarted the clock at a new 30, which seems like it's in the lender's benefit. If I had gone for something like 20, I could have taken some of that benefit back myself without going all the way to 15, but I didn't realize it or think about it at that time. Was that option there? Would lenders have allowed or entertained a term somewhere between 15 and 30?
The answer is yes. And a lot of times they don't tell you that. But, and this is something, and you bring up a great point, Fred, because a lot of people don't consider, that when they do that refinance, almost every single time it restarts the clock back from year one. And think about all the time that you've already spent paying into it. Now you're starting all over again. And if this is your personal home, then paying off your home might be part of your personal retirement strategy. And now the clock has been reset. So how do you catch up? And our program can still definitely help you with that. But when you're working with doing a refinance, you can always talk to them about doing maybe a 20 or a 25 year. Some will offer one or both of those options. 15-year might actually be a little bit too much to pay, per month. So having a 20 or 25-year option might be good. And some may actually be able to give you the same amount of time remaining that you had on your original mortgage. But you have to ask them up front about this. But I think locking it at a 3% rate is fantastic.
Yeah, I feel lucky I got it at the time. And
definitely.
The main thing was closing out the risk that the ARM could flip into what would now be, it was going to flip in April of this year. So the rates wouldn't have been 6.5. They would have probably been more like 4 at that time or something around there. But either way, I just wanted to sleep better at night, not worrying about it for the last year. So that's the way we went. But now in hindsight, I think I should have asked or pushed harder for something like a 20-year or even 23 years to reflect that we were 7 years into it or 6.5 into it and gotten some of that value back.
You know, it's not too late. So our program typically for individual homeowners that are just doing it on their personal home, we can reduce the amount that you pay on it by half or even a third of what you originally had. So if you're scheduled for 30 years, we can bring it down to at least 15. And many times we can bring it down to 7 or 8 years. So we can save a tremendous amount of time and also interest that you would have paid. And then something else to think about, and I think what you did was, in my mind, I would have done the same thing. And the reason for that is because last January, it was announced that the government was actually going to begin selling mortgage-backed securities that they had been buying since 2013. Now, the government started buying mortgage-backed securities in 2013 to artificially stimulate the growth in real estate by suppressing interest rates and mortgages. And last March, they had announced that they're going to end buying mortgage-backed securities altogether and continue to sell. Well, this month, September of 2022, the government just announced that they are going to offload everything that they have in mortgage-backed securities. And if I remember the number correctly, I believe it's about $95 billion a month, which is what they plan to unload. Now, since they've been doing this since 2013, it's going to take years to unload this. It really makes me wonder how this is going to impact our interest rate long-term going forward. So in my mind, what you did, Fred, I think I would have done the exact same thing.
Okay. There was another thing I've learned, maybe the group can benefit from it, because I learned after the refinance a couple months ago, I got an email from Credit Karma telling me that my wife and I's credit rating had or credit score had dropped by about 15 points one month. And I couldn't understand why, because we pay off all our credit cards and everything monthly, and nothing was delinquent. So I started digging into why the score had gone down. And what I discovered was that you know how mortgages get sold but all the time. Well, our mortgage after the refinancing had been sold already 3 times since last April.
Wow. I don't think I've ever heard of that.
Or it was last July. Yeah, it got sold right away, like within a month after, which
that's not unusual.
Expected. Yeah. Yep. And then about 3 months later, it got sold again. And then this spring, late spring or summer, it got sold by that lender to JP Morgan. And so what happens is, and I didn't understand this or know it, is that every time it gets sold, the bank that's reporting it to the credit agencies, they restart their own clock, because to them, it's not a mortgage that we signed 7 years ago in 2015. It's a brand new mortgage that only has 3 months on, or actually, that's not true. To them, it's a mortgage that was signed in July of 2020. So it only has coming up on a year. So it has less than a year worth of history. Whereas I'm thinking as the borrower, I've got a credit score that's based on a mortgage, having a mortgage in good standing for 7 years. But that's not the case. I'm only getting, at that time, it was 11 months, I think, worth of recognition for that mortgage, because that's all JP Morgan is reporting to the agencies. They're saying, we have a mortgage and it's been in good standing for 11 months. So when I started calling TransUnion and the other one, I can't think of their name,
Equifax and Experian.
Yeah, I was going to file a dispute with both of them. And they said, well, have you called the lender? And I said, no, I think the problem's on your end. And they said, oh, no, we just base it on what the holder of the mortgage reports. So then I called Chase and I was ready to fight with them. And they pulled it up and they said, oh, no, that mortgage was signed last summer. And so it's less than a year old now. And then the light bulb went off for me. And I was like, oh, of course, the old mortgage got extinguished. It got paid off. And now the new one comes in. Do you know any tricks or any techniques to try to avoid that?
Is that
I don't know
legal?
any tricks. Well, I don't
It could
know.
be
And I've
legal.
never heard of that.
No, I
But-
never heard of that. That should not affect your credit score. That's
Correct, because
only
it's not a
between the
transaction
banks.
you're performing.
The
This is a
previous
transaction
loan,
that's being
did the
performed behind
previous
the scene.
loan and its history fall off of your credit report? Did the previous loan history fall off your credit report from that lender?
From the lenders that had held the mortgage, I think it was showing in my history as an account that had been closed, but it had been in good standing and there were no
And
defaults.
closed paid in full? Because
Yeah.
that should still affect your credit score positively. Like everything that you explained makes sense. Like the new Chase loan would pop up on your credit report, but that old loan with the history of you paying it over the course of time should still be on your credit report in some way, shape, or form.
I think it is on the report in the history, but you know how Experian or any of those agencies show you what goes into the score, and they say one of the things is the age of your accounts. Well, basically, I thought I had an account for our mortgage that was 7 years old, and what's now shown on my credit profile is a number of accounts, but the average age, once you take out the 7 years and replace it with a 1 year, the average age takes a hit. And it
But
goes
shouldn't
down.
that 7-year history should still be there as part of your credit history?
Yeah, it's still there, but it affects, like he was just explaining, as he was explaining, when they go to calculate his actual credit score today, it basically goes from a 7-year loan to a monthly, a loan that's only a few months, because they're counting his active loans, and that loan now shows up as a closed one.
Right. So I don't get penalized for any defaults or late payments or anything, because there were none. But where I get hurt or I take a hit is that the average age of my accounts now drops. It drops from what used to be above 5 years to something below 4 years, or below, closer to 3.5 years, and that affects the score. So at the end of the day, I think that's what was causing my credit score to drop the 15 points, which, I mean, it didn't move me from one category to another. I think it went from high 7s to mid 7s in that range, but I was working hard to try to get to 800. And now I was set back closer to 750. And I was like, shoot, I'm trying to do everything I can to get that score up, not down. And after a bunch of phone calls and digging, that's what I came to conclude, that it was the refinance and the age of my open accounts was now lower. And as a result, the rating agencies were lowering my score. Does that all sound right? Is that the way you think it should work, or should I go back and fight some more?
I would think it's the same loan that you signed on. Just because they sold it between banks should not affect your credit score whatsoever. What they do internally is up to what they want to do internally, but they should not be reporting anything to your credit.
Yeah, I think selling the loan doesn't change it. It's when I did the refi.
Well, you know, I think, Peggy, you're on to something in that it would seem to me if we talk to an attorney about this, the attorney would say, well, you've been damaged. Why? Because your credit score is a little bit lower than it was 30 days before. And if you go out and try to obtain credit now, you could be paying more than you would have done 30 days ago through no fault of your own. And
right, because your loan documents say exactly the same thing.
Right.
Who cares? The credit card companies don't care, or the scoring, whatever they're called, don't care this is some things being reported. I don't know. I would talk to somebody, maybe someone like Cliff could have a conversation with you and guide you to the right people, or he might be the right person.
I think it was the refinancing that I did that actually triggered the problem for me.
How long ago did you do it?
Last July.
That's a year old. That shouldn't affect your credit now.
Right.
What
And
was that?
I'm not an attorney. I only play one on TV. but I smell class action lawsuit or something like that, because you are probably just one of tens of thousands of people that happens to, regularly on a monthly basis throughout our country. And it doesn't pass the sniff test to me, Peggy. I don't know about you.
Yeah,
it doesn't sound right. But Fred, I would say this also. I don't use services that utilize Vanguard for scores because they're not always accurate. I actually use actual FICO scores. So the service that you mentioned earlier, I believe it uses Vanguard. I would actually find the Experian, Equifax, and TransUnion scores and look at those. And that will give you more of a true guide for where your score is today.
Right. Yeah, that's what I use. I mean, Credit Karma monitors Equifax and TransUnion.
Vanguard score.
Yeah,
that's a Vanguard score.
Yeah, it's not the same.
Okay.
I don't use that at all.
Marcy has a comment.
I have a question, Fred. How long have you had your credit cards? Would you know the average age of all your credit cards?
I didn't use credit that much until this little, it's all kind of connected in a way. I didn't use credit cards that much after about 2010. I was more of a cash person. And then when my wife and I went to buy this house we're in, I thought we had a big down payment. I thought everything was going to go fine in 2015. And then we discovered that my credit score was actually lower. And that's why we ended up having to take the adjustable rate mortgage, because it was a jumbo mortgage. And because my score was lower, we qualified for the adjustable rate mortgage at a good number, but
they say, let me interrupt you a second. They say cash may be king, but credit is queen.
Right.
It's after the fact, but anybody should have some credit, not credit cards from a department store or Home Depot. Right. Credit cards issued by a bank.
Right. Good.
Yeah.
That's what's going on today. It didn't used to be that way, but that's what it is, especially the past couple of years, because that's what lenders look at, because what they want to know is how have you paid your credit off in the past? Are you a hell of a good risk for us? Or were you late a couple of times, or you all of a sudden maxed out a card at one time or another? So they look at a lot of things on your credit card, not so much as the one-time happenstance of a refinance. They'll take that into consideration.
Okay.
You have to take a look at everybody has to have credit these days.
Thank you, Marcy.
And we want to give you an opportunity to ask your question.
Thank you. Yeah, and this question is for you, Cliff. I was just curious on your calculator. Do you have the ability to show somebody staying with, say, that 30-year mortgage, but just taking the approximately $1,000 difference and applying it towards principal and comparing that to refinancing into the 15-year that did require about $1,000 more out of pocket? I'd love to see how those two would compare.
The calculator that I have here does not do that, but the analysis that I do does.
Okay. I would think that based on what you're saying, it would probably be even more advantageous to, one, have the flexibility of payment, but also it might be effectively pay it off sooner than 15 years by doing it yourself. But yeah, obviously we'd have to see how the numbers crunch out. But
yeah, like I said before, if someone just has a mortgage by itself and it's just their personal residence, our program typically can cut that down to, I've seen about 14 or 15 years as being the average. It's going to be different for everyone depending on the circumstances. But if they couple that in with more variables, more things that they're actually paying on that charge interest on a monthly basis, I've seen that bring that 30-year note down to 7 or 8 years. And of course, that's also going to vary depending on circumstances. It could be 10 years, but still it makes a pretty significant difference.
Yeah, I would think that would be very valuable to demonstrate. Thank you.
Well, maybe we'll have
Thanks
to
for
come
your
back and
question.
demonstrate. So we are past
Okay.
the top of the hour, and I want to thank everyone for coming. And we hope you will come back another time and speak again about the subject and other subjects.
Absolutely. Thank you.
Thank you.
Great job, Cliff.